Hey everybody, Courtney Smith here with our Wall Street winners for July the 19th, and there's our disclaimer for July the 19th. All right, let's take a look at the box in the upper right-hand corner here. Now, I told you last week we had the momentum divergence and we would get a sell-off, and we did. Of course, I am 100% correct on all my predictions. Of course. All right, okay, maybe not quite 100%, but pretty darn good. So we've got the sell-off here. I think it'll continue for a little while. There are some weakening signs in the market, and then there's some strengthening signs. So it's a very unusual type of situation where we see indicators getting better and worse all at the same time. And of course, that's the kind of thing you'd expect in a late summer, choppy, sloppy behavior. So let's carry on. So here we see that the little green line, that's buying pressure, the little red line, that's selling pressure, pretty close, pretty lined up pretty closely. The black line is going horizontal, saying that it's a neutral market. Sounds about right to me too. NASDAQ got the sell-off that we told you about. There's the momentum divergence as well. We make a higher high on the price, but not a higher high on the RSI. That's a little more, it just calls for a couple days down, so we got 4 days down. Purple predictor though, not looking good on this drop. Seasonality, we're neutral. It's in the middle of a seasonal, but this is something interesting here. That sell-off in the stock market has caused a flight to quality into the utilities. And a break above this red line here would turn me bullish, and I would buy utility stocks, partly as a hedge against the market going down. Here's the seasonality. And what we want to do is we want to use this red line. That's the post-election year after an incumbent party loss. Or, better yet, the purple line that's up here, which is the first year of a Democratic president. So either way, it's bullish. So we should see, last time we were looking at this little dip. Now we're looking at a little bullish. So the dip that we're seeing here right now probably is going to end by Tuesday, let's say. You can set your watch by it. Okay, now asset allocation remains very neutral. We're basically the same place we were back in April. Very choppy. So there's no money coming into the market, nor is there money coming out of the market. And of course, guess what? That sounds a lot like a neutral market to me. All right, the RISKDICATOR, though, took a dive here. Why? Because they didn't like the NASDAQ stocks more than they didn't like the Dow and S&P type stocks. So that took some risk out of the market. Generally, that's not good for a market when risk comes out. Another thing that's pretty fascinating is the European stocks are the ones that are leading the move down. They're leading it down. They haven't made a new all-time high here for a month or so, a little over a month. The yield curve slowly degrading, not to a danger zone yet, but this is a wrong way. If we have a strong economy, we should be seeing this yield curve get wider and wider, but it's getting narrower and narrower. So that's another background worrying feature, not a crisis signal, but a worrying feature. Over here, bonds moving back up again. This is another sign that the economy is not doing well. Our bond key factors. The green line is the bond yield. The blue line are bond yields in Germany. They're clearly saying we should have higher bonds, lower yields. Gold is even not really, is kind of saying we should have lower yields. Only commodity prices, which are a leading indicator, are saying higher interest rates. Now, if that's the case, we should see the dollar strengthen, and we are seeing the dollar strengthen. Sluggish bull market, but nonetheless, a stronger dollar. Why? Because the U.S. economy, even though we're talking about it being weakening, it's better than everything else. As they say, it's the least dirty shirt in the laundry. And then gold rallying up, and let's go back to this. So here's the dollar going up, and here's gold going up. Not often does that happen, but here we're seeing it. I want to be long gold. I think that real interest rates are becoming more and more negative, and that's going to really help out the gold market here. But we got to wait for the technical signals. Even though I think the price of gold is going to go up, the question is, what does the market think? Market's not sure. So it's kind of a sideways, slightly bullish market. Gold indicators, once again, a mixed bag. One slightly bearish, one neutral, one slightly bullish. So like, who cares? Don't bother with gold right now. Crude oil coming down a little bit here. I thought maybe we would get a rally and start to move back up again, but the weakening economy is driving the price of oil lower. So I was a little bit wrong on that one. Is there a message in all these things? Yeah, the economy's not booming anymore. That's it. We're over. See you later. Bye-bye. And Bitcoin, of course, isn't going to be helped either by a slowing economy. So we're seeing this sluggish bear market that we've been talking about for over a month continue here in Bitcoin. I don't have a position in Bitcoin, but if I had one, I'd rather be short than long. This is clearly not a bull market, and you only want to be long Bitcoin in a bull market. You don't want to be long Bitcoin in a bear market. And what we have now is a sluggish bear market. All right, freebies, we will talk to you next week.